Please welcome to the stage Jay Bigelow, Head of Founder Engagement at the Center for Entrepreneurial Development.
Good morning. Good morning. There you go. Thank you. Welcome to day 2 of Venture Connect. Yesterday we had an interesting conversation in the morning about our goal of $20 billion of additional enterprise value in the ecosystem and what it'll take to get there. Hopefully you all got a chance to talk to the people that were on stage, but also the companies that are presenting. Today we're going to continue that conversation with a slightly different perspective. And one of the concerns, one of the things that we often talk about is how do we compete with other ecosystems? How do we stack up? We're going to dive into some data that talks about that in a minute. But no conversation around the triangle, our ecosystem, and how we accelerate it would be complete without a conversation with Bill Spruill. Hopefully many of you already know Bill, or at least know Bill's story. We're not going to have time to get into the whole thing, but I'll try to drop some pins. Goldsboro, Los Angeles, Chapel Hill, CED, Dataflux, SAS, Address Doctor, Global Data Consortium. It's been an interesting entrepreneurial journey for sure. Global Data Consortium, if you don't know, was purchased by London Stock Exchange a couple years back. And what Bill did with that is decide to reinvest in everything that he can in the ecosystem and building a stronger ecosystem. Not only were 20-plus millionaires created as a result of that, so as you may have heard from Chris Chung yesterday, there is a GDC mafia. Some of those people are probably here today. But he's also invested in ecosystem building. Chancellor's Innovation Fund, which has been going on at NC State for a few years, has benefited from Phil's generosity and support. I heard a speech on Tuesday that said maybe that's going to expand even beyond North Carolina State University, which would be great. He's created the Achievers Program specifically for minority founders, try to accelerate their business and create generational wealth. He set up his family office, Second Foundation. For those of you who are Asimov fans, you might know what that means. We usually refer to it as 2NDF. And he's also invested in CED and our ecosystem here. So what we'd like to do is bring Bill on stage, continue this conversation, and see if we can turn some of these ideas into actions as a result of today. So please welcome Bill Spruill to the stage. Thanks, man.
Thank you.
Good to see you.
You as well.
We'll see it in a minute, I guess. So I took some notes from yesterday, so you're going to get quizzed. One of the things that we talked about with the founders yesterday was what are some things that would be helpful for the ecosystem. So I'm going to jot a couple notes down. More West Coast flights, density, finding the right mentors, the human flywheel, getting people to spin out of their existing companies and start new companies, swinging for the fences. Those are a few of the notes that I had. From your perspective, what are those things that are going to help accelerate our flywheel, make it go farther, and make it go faster?
So I think all of those things are going to be useful. We absolutely always need more flights. We always need more. But the number one thing we need to do, I think, in this community to help is to change our mindset and our framing. And I think it was mentioned yesterday, go big, go home as part of that. But one of the mental models I've learned over the last 3 years post-exit is that categories of people typically are living in either survival, thrival, or aspirational modes. We need more of our founders, more of our community writ large living in the aspirational mode of growth and how the triangle area can be competitive globally with other markets such as Singapore, Sydney, Australia, Dubai, London, elsewhere. We have to get out of this mindset that our competition and our mental model is Atlanta or Nashville. We're bigger than that. We have the capacity to be better than that. We need to play up as opposed to just simply play complacently.
Awesome. I guess I need to interrupt for a second because people may be wondering why there's a park bench behind us. It's an unusual visual. Those of you who know Bill know that he collects people, and he collects people on a global scale. Once we're having a dinner with him in Boston, and the other people at the table were from Australia, and we were in Boston. So that's what Bill does on a global basis. During COVID, when he and I would get together, of course, we had to be outside, and we had to have social distancing. And so we would meet in the park in Raleigh. And Bill referred to it as two old men at a park bench feeding the pigeons. So we decided two old men on the park bench inside the hall. That's why that picture's there. So address what we need, or what you think the mindset shift is. What are areas of opportunity? What are things we have that we could build on that would help that acceleration?
So, I think yesterday, I think it was Brad who, mentioned the fact that the state can actually now really get in the game in a very unique way in terms of real estate. Obviously, we're a long way still from our state investing in venture capital or direct investing in companies. But the notion that the state will actually help build buildings for companies, I think is huge, especially when we think about deep tech-oriented companies that need unique space to operate in. So I look at public-private partnerships as a big part of that. Other things we need is, again, our state, local governments to sort of get on the bandwagon that while it's great to attract headquarters companies here, it'd even be greater to actually help grow headquarters companies here. I kind of look at it in, I try to put it in language that everybody can understand. You could have a sugar high and it goes up and down. You attract a headquarters company here and it's great until it's not great and then it magically goes away. Or you can have a long-term carbo burn. And that's where if you are growing headquarters companies here, we have that long-term growth opportunity. We've got the state investing in real estate for those companies to grow their staff, grow their people here. And when you think about attracting executives here, you can actually show inbound executives, hey, if I move to RTP, if this one opportunity doesn't work out for whatever reason, there's 5 more that I can pivot into. It's not a one and done situation. So getting everybody on the same page and playing from a playbook of being aspirational, and aspiration isn't just attracting Apple here. Great, we'd love for them to build some buildings, hire some people, do their thing here, but being aspirational is how do we build the next 5 Apples here? And that's gonna be far more long-term impactful for the state than any short-term secondary HQ.
Feel free.
I'm not running for office. I'm just an old guy on a bench throwing peanuts. Just remember that.
We thought about bringing the pigeons in, but we decided that probably would be too much. You mentioned deep tech. I know that's something you're passionate about. What can we do in the deep tech space? What is this area uniquely qualified to do with deep tech?
Sure. Well, I'll sort of approach that from 2 points. If we want to think about going where the opportunity is, this area has a robust bench of, I'll call it non-software related opportunity in terms of deep tech, dual use defense, biologics, therapeutics. And this has been our bench strength for years and years and years. We've underinvested, generally speaking, in that community in favor of a rotation into enterprise software. I happen to be a personal belief, and again, old guy on a bench today riffing, I think the opportunity for us, the arbitrage opportunity is shrinking rapidly in enterprise software, and I think we should go where we have our strengths. And I think deep tech dual use defense is where it's going to be for the next 5, 10 plus years. I think there's a great investment opportunity there. And most of these other communities that we talk about competing with can't even get close to the resources and what we have here in terms of IP research and ability to commercialize. So we should be doubling down, tripling down on commercialization of tech out of our universities, out of our research institutions, and we should be taking full-on advantage of that at this point in time. Our investor class should actually start to look to pivot, recognizing that the LP class actually also has to be willing to say it's going to take longer for us to see results. But again, if you want that short-term sugar high, that's great. But if you think about that long-term high of building a big bench of deep tech headquartered companies here that are accessing the defense community and all based here in RTP in the North Carolina region, that's what I see as a great future, or potential great future for the state if we're willing to lean in and do that.
This coming from a software guy, right?
Hey, I'm a guy who made my money in enterprise software, but I was smart enough to know that maybe the bloom's off that rose and it's time to pivot. Go where the puck is headed,
Awesome.
not where it's been.
Awesome. One of the phrases I learned in the 80s was think globally, act locally, right? You are a global citizen by your own definition on your posts. What are the things you mentioned, other markets, other places we compete on a global scale? What are the things you've learned around what happens in the rest of the world, thinking globally, that we can apply here locally?
Well,
what are your lessons?
Look, the lessons, I'll tell you the most recent lesson I was in last week. I was actually in Sydney, Australia, and I spent 2.5 weeks in Sydney proper, and I can tell you they are getting it done. They are back at it. Their RTO is a thing there. It's been past a thing. I talked to a few people there. They are actively engaged. They're young people. Are getting it done. I was sitting in restaurants out in Bondi Beach and watching people coming home on the buses, and they have a great, robust transit system there, by the way. Tap on, tap off. People don't think about driving for the most part. You take the bus, you may take a train, depending on what suburb you live in. But the key thing I saw was that people were coming home at 8 or 9 o'clock at night, and they hadn't necessarily gone to dinner yet. And that told me that they were getting it. I saw, 20-somethings, 30-somethings getting off the bus. They had their gym bags in hand, and you could tell that they were coming from their offices in downtown Sydney. They'd come out to the burbs because that's the place you want to live, is at the beach, the city beaches in the Sydney metro area. And they had been at work all day. They were getting it. And I think the one thing, again, going back to this aspirational mindset, we've got to get it. We've got to get up. We've got to say, this is our time to lean in while other people are still struggling with what to do. I think it's an easy answer of what to do is, get at it, get to work, and make your community a better community.
2 old men on a bench. We need to work harder and longer, right?
Hey.
There was a day.
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 It's hard to get up this morning at 06 to make sure I was here on stage.
Everyone's telling me my voice is very gravelly. Evidently, there was too much drinking at the event last night. So apologize
that's a different issue. But that's another old man issue.
That's another issue. One of the things that we talked about, Kelly brought up yesterday, was our deal room platform. Our deal room platform is our public scorecard of how we're doing against this $20 billion increase in valuation. It's open to the public. We're making it available to every company in the triangle to update their own profiles. The deal room is a global platform. They just released their first report on how ecosystems around the world are doing. It's our public scorecard. So I encourage you to go there, update your profiles, use that as a score of how we're doing as a region. There's another set of data out there that if you're not aware of, you need to be aware of, and that's the data that Carta is generating. Peter Walker is here today, a guest of Bill. He and Bill are going to talk a little bit about the information that Carta is delivering for the ecosystem. We're going to have some Q&A, maybe, depending on how long Bill and Peter talk. So be thinking about your questions you want to have for Peter. Peter is a self-proclaimed data nerd, recovering entrepreneur. He started the data analytics practice at Carta. So again, if you're not familiar with Carta, they have about 45,000 companies' cap tables. And that's what he looks at on a regular basis to provide insights. So with that, I want to welcome Peter to the stage and let Bill and Peter continue the conversation. Please give a warm welcome to Peter Walker.
Thanks again.
Great to see you.
Good to see you again. All right, now I get to take over for Jay. Old guy swaps in. So Peter, I got to know Peter like most of you because if you're active at all on LinkedIn, Peter pops up. If you are active tracking data, Peter pops up. And this past weekend, I was actually at the gym working out and listening to a podcast. I'm a big fan of Invest Like the Best, if you are familiar with that podcast. And they were doing an interview with Michael Ovitz, who was the founder, head of CAA, for those who may not know that particular name. Pretty influential guy and pretty smart guy along the way. And the topic was information is power, knowledge is power. And when Michael was talking about people who actually achieve positional power in organizations and industries, it was amazing to me because I said, oh my God, this is Peter. He has put himself in a place as head of data insights. He is not the founder of Carta. Apparently that comes up way too often for people, but he is the head of data insights at Carta. See, covered my base there. But he has put himself in the position of informational power when it comes to what's happening with companies, what's happening with employees, what's happening with investors in terms of equity, investment, and funding rounds. And so I'm thrilled to have Peter here. I appreciate you making the trip out from San Francisco, and I'm hoping we get some really great questions here because this is, I won't say it's a once-in-a-lifetime opportunity, but it's a great opportunity to ask the hard data questions. But before we go into that, Peter's going to share some data with us, and then we're going to get into some back and forth. So I'll kick it over to you, and take it away.
Thanks so much, Bill. I would say not a once-in-a-lifetime opportunity. I plan to be back in Raleigh at least once more before I die. So maybe this is the last one of two opportunities. In any case, thank you so much for having me. We're going to rip through a lot of data, again, about what Carta is seeing in primarily the venture-backed startup space. So we'll get into a bit of a conversation here about bootstrapped and venture-backed and the ways that people are building companies. But let's just start with some of the overall context that might be necessary for you all. First thing I like to start with, if any of this is interesting, sure, you can take screenshots with your phone. I love that. Then, it's great for my vanity. But you can also just email me and I'll send you the slides. They're all public. So this data comes from Carta. We are an equity management platform and a fund administrator. So we deal with both venture capitalists and the companies they serve. We have about 45,000 startups on the platform today. And the data that we have includes priced equity rounds as well as everything that's happening at the earliest part of the company lifecycle, safes, convertible notes, all that stuff. And this is all US data. We do serve companies, by the way, outside the US, about 100 countries now. So what's the context? If there's one chart that explains how people in venture are feeling today, I think this is a pretty good one. And if there's one word that explains this chart, I'd go with hangover. We got a little wild in 2021, as those orange bars indicate. In the Q4 of 21, companies on Carta raised collectively nearly $70 billion in a single quarter. Overvaluations, funding was too quick, interest rates rose, and then we've been dealing with that for the last 3 years. So for the entrepreneurs in the crowd, it may feel difficult to fundraise. I'm telling you right now, that's the normal feeling. If you had friends in 2021 who raised at a snap of a finger, that was the aberration. And it's not like you can look at one part of venture and say, oh, that's so healthy, and another part of venture and say that's dealing with specific challenges. This downturn has impacted every single stage. So this is just the percent change from the peak in total capital by stage. Seed is doing a little bit better than late stage, but it's not been fun really for anyone. And so let's jump into some useful tips for entrepreneurs today. The first one, the primary one of the single most important jobs as a founder is don't go out of business, don't run out of money. That orange bar, right, that orange sort of zone in the middle there, that's the standard VC advice, which is you're going to raise around every 18 to 24 months. And if you look at the lines, that was pretty good advice for a long time. That advice is now out of date. The median time between these rounds is getting longer. So if you were planning on making that round last for 700 days, and now you have to make it last for 1,000 days, could you do it? What would you need to do to your business in order to make that happen? Many, many entrepreneurs have been facing this exact challenge over the last couple years. So I didn't do a poll beforehand, but I'm sure there's many venture capitalists in the room. I promise if I take shots at you, it's in love and jest. But what have VCs been doing in this interim period where they weren't investing into as many new companies? It turns out that they were helping the companies they had already invested into. So the bars on this chart just show the percentage of bridge rounds by stage. Bridge round here defined as led by insiders and generally for less money than the primary round itself. So a company comes to the VC and says, look, we were trying to hit a Series A. We can't quite get there with the money we have. Can you give us an extra $200,000, $300,000, $500,000 so we can get there? A lot of that is happening. I'll say our data says that bridge rounds are typically not a great investment, as you might expect, but I think it's actually pretty cool that a lot of VCs are still helping their current portfolios through this mess. And if you wildly overfund companies in 2021 at really, really high valuations, I think it's pretty reasonable to expect that 2 to 3 years later, you're going to see this chart, which is companies are taking down rounds far more frequently than they used to. Valuations have dropped. There's a silver lining to this, which is if you take a down round, it means your business did not close, which is good. Survive another day, but it may not be worth what you said it was worth at the very peak. And this is not a great chart to show at a screen this size. I should have reformatted it. But effectively what this shows you is the graduation rate. So how many companies get from a seed round to a Series A and over what period of time? So if you focus just on that column that says 2 years, you can see that in the boom times, something like 30, 35% of companies would jump from seed to A in 2 years or less. Now that's more like 17 or 15%. A lot of companies getting stuck along the way here and having to either pivot their businesses to become profitable and cash generating or figure out another way to keep on the venture hamster wheel, which is very difficult. So that's what's been happening with founders and investors. But what about the employees? What about the people who work for these startups? Carta, the tagline of Carta for the last 10 years has been create more owners. And we do that by incentivizing employee equity. So this is actually a really important chart for us, and it's kind of a sad one at the moment. Employees at these startups are exercising less than a third of their options last year. That is a wild stat. I'll say that again. When an employee leaves a startup company, 70% of them are saying, no thanks, I'm not going to exercise my equity. It's as though you gave me no options in the first place. Now, why would employees be doing that? Are they making mistakes? Sometimes, yeah, maybe they lack some education, et cetera. A lot of the times, they're making smart financial decisions for their families because they say this equity is not going to be worth the cost of exercise and tax. We just don't believe in the exit. We don't think an M&A is coming. We think we got overvalued and our strike prices are underwater. There's a lot of reasons why this equity isn't turning into actual cash, which is a big promise of startups, and it's one that I hope to see renewed over the coming years. All right, so I was told I needed to include this slide so we could talk about outcomes.
Yes.
So, we talk a lot about startups, how exciting they are, et cetera, but when you are building a company, especially a venture-backed one, you're looking for an exit. Two kinds of exits, IPO or M&A, mostly, when we talk about startups. So we tracked over 4,000 startups that started in 2018, and we said, as of the start of this year, how far did they get? How long have they gotten in their venture capital journey? How many of them exited, et cetera? And you can see the outcome stats on the bottom row there, which is 15 IPOs, so less than 0.5%, 239 acquisitions, so about 5% so far. 30 of them are still kicking, which is great. 62% are not. And you've got some unicorns in there as well. And this, again, is why that employee equity stat is so important. When you join a startup, especially a pre-seed or seed startup, that is a very risky bet. The most likely outcome is that this company is not going to work. But you do it anyways because you love the space, you want to solve problems, and you think you have something to contribute to the startup world, which I love, even in the face of maybe some sobering statistics. Anyways, I'll pause there. That's the overview. I hope I didn't depress you too much. But I promise there are some optimistic silver linings coming soon.
So that's a lot of information. I think I'm going to start today with a conversation we had last night over dinner that I found to be interesting. Being an ancient person, sometimes I refer to myself as a Time Lord, for those who may be Doctor Who fans out there. I come from a time when you had two different vehicles, convertible notes, and you did price rounds. Those were kind of the options.
Yep.
Then, of course, the magic of the safe appeared.
Yeah.
And safes seem to have taken over the world. And the conversation last night was this whole issue of safes, convertible notes, and I've heard this discussion over time here in this community.
Yep.
I think your data shows that, without a doubt, the universe has pivoted, and this is where we are. Speak to that.
Yeah, I think that you were fed this question by someone who doesn't love safes, if I remember specifically.
Without
we won't
a
name
doubt.
names.
We will not name names.
That's fair. Yes, so SAFE, Simple Agreement for Future Equity, the easiest and most convenient way to take in money to a young startup. Effectively just a convertible note, but without an interest rate, because who likes an interest rate? That's for the Time Lords only. To be honest, I think that the debate between safes and convertible notes is an interesting one. Safes have come to dominate the space. In our data, it's 90% of companies are fundraising on safes instead of notes. The ones that are still using notes are biotech, hardware, a couple, slightly more real-world industries, where interest rate might make sense on actual assets. But in general, safes have come to dominate, and I actually think that's a good thing. I know some people outside of Silicon Valley have their problems with safes, but I think they're really great for the first round of capital. I think people get into trouble when they use them for 2 or 3 or, hey, we've seen 8 rounds of capital done on a safe. And in that case, you're really just kicking the can down the road on some things you shouldn't. But in general, I think they're a great instrument.
Got it. So when you're using safes in terms of, for instance, maybe these bridge rounds you were just talking about, that's where it actually becomes less helpful.
Look, if you've already raised a priced round and the only bridge that you can get is on a safe or a convertible note, I gotta tell you, it's a bad sign. It's a bad sign. The math does not usually work in that case. Why are you not then putting a new valuation on the company? Most of the time, people use a safe after a priced round when they want to avoid a down round. And not just founders, investors do this too, but it is not a good signal. Right. Our data says that it's more than 95% of the time you won't get to the next stage.
Right.
Yeah.
Everybody wants to chase the markup as opposed to chase the reality, if you will, of the situation.
I mean, bitter pills are tough to swallow, but maybe better than kicking fantasy land down the road. Yeah.
Absolutely. And that happens, you see that in public markets where you have to sometimes just restate.
Yep.
And understand where you really are in the world.
Yep.
And restart that beat and raise motion.
Totally. I know this might be on your question list, but discussion of safes and notes for the entrepreneurs who are thinking about kicking off their venture capital journey, really you should take a step back and ask that question, which is, do you need this money? How badly do you need this money, right? And the second question you should ask is, no, really, have we considered bootstrapping, right? Venture capital is the most expensive form of capital you will ever take into your business. If you get a loan from a bank and you pay the bank back, you then don't have to talk to that banker every quarter at your board meetings. That is not true for VCs. They are with you sometimes longer than your spouse will be with you, all right? So this is a marriage. I love VCs. I think they provide an amazing service. But especially in this moment right now, companies are being built in a whole host of ways, some of which involve venture capital and some of which do not. And there is no morally correct way to do this. One way is not better than the other.
Bold statement. And, I'll lean into that statement. Bootstrapping is certainly something that is slowly coming into vogue. It was certainly not in vogue when I built my organization.
Yep.
We tried to raise, we couldn't raise. I was a really bad. It was all about me, not the market. No one believed in what we were doing. It was because my pitch was bad.
Don't blame yourself.
Hey, it turned out okay.
It worked out.
It worked out just fine that we didn't raise capital because we, in essence, were able to bootstrap to one strategic round,
Yep.
which allowed for our team to basically reap the benefit of that equity outcome.
Yep.
Now, your statement is valid, but it's not applicable across all industries. Obviously, if you're building a therapeutics company, you've got to raise money.
100%.
You've got to do things.
Yep.
But I think in terms of enterprise software, I think we would probably both agree that it's cheaper than ever to build an enterprise software company.
Yep.
We're likely on a trajectory where, because of AI, we're going to see more companies that are built that are solo founders, single-person billion-dollar organizations. Is that kind of a fair notion that can happen?
I mean, if you ask Sam Altman or many acolytes around Silicon Valley, yes, we're all waiting for the one-person billion-dollar company. I think we're candidly still pretty far away from that, but getting closer. To your point, bootstrapping is not an option if you are building a therapeutics company that is going to require real capital to get it off the ground to create therapeutics, et cetera. But this maybe speaks to Bill's journey here. There's so many different ways to build these companies that involve venture capital, sometimes at the very beginning and sometimes later on. Right. So you can bootstrap, where you take no money and you're revenue generating. You can go the full VC route, where you raise all of these alphabet rounds. You can seed strap, which isn't a term I love, but is the new vogue, which is I'm going to raise a little bit of capital and I'm going to see as far as I can get with that. Or you could do bootstrapping that turns into venture capital once you've built a business. Yeah. Like Bill did, take in strategic investors at a later stage when you really want to fuel growth, but the beginning part of your journey is all through revenue generating capacities. And this mix it's much more, all over the place than it was, I think, a couple years ago. I think since the venture capital downturn, founders have been struggling for cash and also turning to alternatives and creative ways to fund their businesses, and some finding with the advent of AI that they need less capital than they expected.
Absolutely.
Yeah.
In fact, I think I was talking with an investor yesterday, and the idea is you can actually increase your margins. You can increase a lot by, again, more leveraging of AI
Yep.
within the business, which
Yep.
means hiring fewer employees,
Yep.
which in theory keeps that equity pool contained and maintains the value of the overall business.
Definitely, yeah. I feel like it's, part of me is sad in a way because I started a company in college and I got, after that I had a great time being first 10 employee at some young startups. And it is an unbelievable experience. It is such a brilliant way to learn about business, learn what you like and don't like, increase your own agency. And so I hope that a lot of people still get that chance. But no doubt, AI is starting to reduce team sizes. I'm here to tell you, by the way, that if you are reading a bunch of people that said AI won't take jobs, that is a lie. That is a complete lie. We are already seeing that happen in startups. A startup that would have needed 10 engineers that now needs 3 it didn't mean that you fired people, you just never hired them. And that is the same thing. So that is happening across Silicon Valley right now in a way that has been, it's almost the goal of many of these startups is to see ARR per employee, how high can we get that number? And that involves not hiring nearly as many people as they used to.
Yep.
Yep.
So one of my big missions is wealth creation. And it's important that founders, of course, do well,
Yep.
but I also believe that it's important that teams do well,
Yep.
early employees do well, because then you start to actually scale that flywheel of wealth creation within a community.
Yep.
So when I hear you say, lead off the bat that employees are not exercising that option,
Yeah.
their options, immediately I say, and that is not helping with wealth creation.
Definitely not.
I'll tell this story. Again, recently I was in Australia. In the latter part of our company's journey, we had hired a team in Australia to basically provide 24/7 coverage for our customers. And we had a team of roughly 4 people there. And I actually met with a couple of the engineers that we had hired. They knew because of LinkedIn that I was in the country, and they asked if we could get together, grab lunch. And so we sit down, and they told me the stories around how the fact that we shared equity with them even late in the game was life-changing for them.
Yeah.
In one person's case, it paid for his daughter's first year of education. And in another person's case, they were able to move grandparents from India to Australia with those monies.
Yeah.
And when you think about the value of equity, it changes lives for not just the founders, but for team members. And you hear these stories, and it just makes you feel, it makes me feel really good, but it also shows that you can create opportunity. How do we actually get more people thinking about, how do we change this mindset of that 70% not exercising their options? What needs to change on that function?
This is a whole 2 hours in and of itself. And by the way, I think I'm going to jump around some slides, but again, the full deck is available, so if I speed past stuff, please don't hate me on that. The equity question is a really important one. I think there's 2 aspects to it. One is the mindset around equity in the first place. So it is not just a retention tool. Oftentimes at young startups, especially now, it feels as though everyone is granting equity, but many founders are still treating it as a check the box. We're going to use it when we pitch you on your offer, but once you're here, we're not going to talk about it very much. We're not going to really explain it, and you probably don't know very much about how it translates into actual wealth. So I really respect the founders out there who are going the extra mile and making sure that their employees understand what the equity means.
Right.
How is it exercised? How does it vest? What are the taxes? What does it mean for your family? Right? So that's the first thing. The second thing is that oftentimes what's happened is that equity kind of goes on this roller coaster wave based on what's in the media and what's in the news. 2021, you saw many people were exercising their equity because it felt like it was up and to the right. Why would I not take ownership in this rocket ship? And then the disillusionment that comes from, if you were at a startup that was wildly overvalued in 2021, the likelihood that you're going to exercise the equity at the next startup is much lower because you got burned before.
Right.
So in some ways, I think the equity conversation is intimately tied into how do we value and fund these companies, such that if you can get a more predictable wave where you get maybe earlier liquidity or companies that are rightly valued, by definition, those will increase the employee equity and then hopefully, create more millionaires as you did.
Do you think the idea of keeping a company's valuation lower at the start is a better game than playing the maximize that valuation from the get?
The Silicon Valley clip where he said, I could take a lower valuation? No one told me that. Look, yes, in many cases, obviously a lower valuation will set realistic benchmarks that then you can grow into. I wouldn't say that's always the case. There are businesses, there are companies, and there are founders for whom the maximal outcome is the only outcome that they care about. And that is not a bad way to build. That is, in some ways, the default way that you are kind of trained to think when you're in San Francisco these days, which is, oh, that's a nice idea. What if you did 100 times that idea? What is the absolute maximum that could be achieved by that idea? And here's the money to make it happen.
Right.
I don't think that Sam Altman is wishing he took a lower valuation today. But that applies to a very narrow slice of companies.
Right.
Even venture-backed ones, many of them are not going to be the wild outperformers that they had hoped. And so in that case, a more realistic valuation does give you more options to fund and maybe exit that business from a venture capital perspective into the wider world of finance. Totally.
Beautiful. We know over multiple rounds of capital, the combination of employee and founder equity diminishes while investor equity goes up.
Yep.
I think you've got a great slide, or a couple great slides that sort of speak to that a little bit.
I am. I promise we'll go back. Don't worry, don't worry, don't worry. Okay. So this is the question I get all the time from entrepreneurs. The orange part of these bars is the founding team. The salmon color is employees. The gray, the dark gray, is the investors in that round. And the light gray is the investors that were already on the cap table. How much does each stakeholder group own over time? So two things really stand out to me from this one. The first is, at some point, employees as a group will own more than founders in most of these businesses. Now, of course, there are maybe 2 to 3 founders and hundreds of employees, so on an individual basis, it's not even close, but that does happen. The second point, and the one that I am always asked by entrepreneurs, sometimes with anguish in their voices, is when can my investors fire me? The answer for most companies is Series B. Does that seem early to some of you? Yeah, it is pretty early.
It's pretty early.
In the journey, right? Founders at Series A, the median amount of ownership that the founding team has for venture capital businesses on Carta that have raised in the last 5 years is 36%. Add in the employees, and you're right at that 50% bar for Series A. But by Series B, the investors typically own control. And you may be thinking to yourself, well, they might own more equity, but I will have super voting shares like Mark Zuckerberg. Probably not. I'm here to tell you. We do not see that class structure very often, right? So in most cases, this is why choosing the right investors is such an important part of your journey. I don't sit in this room and think the venture capitalists here want to fire their founders. They don't, right? They're investing in your company primarily because you're in it most of the time. But it does happen, and it can get messy, and so tracking this kind of dilution is important. Beautiful. And I know maybe this is the other one. This is an overall version of this chart, and this is the difference between, say, biotech and SaaS. You can see very clearly, if you're building in hard tech industries, biotech, hardware, et cetera, if you're building physical products, typically you are diluted faster than your SaaS and digital software friends. So comparison is the thief of joy. Don't talk to them too often. You can avoid it.
All right, I'm going to pivot us over towards the investor questions, or more investor focused on that front.
Yeah.
So generally speaking, my perception is that valuations here in the Triangle are a great deal comparative to lots of other markets around the country.
Yep.
How do you actually see that in the data?
I think there are a great deal, but they're also pretty competitive for founders. So this is just a comparison for software businesses across various metro areas. You know, you've got the big ones, Bay and New York, and then a whole host of others. And Research Triangle, this is seed stage pre-money valuations on Carta. That is a very competitive pre-money valuation. You know, 13.5, 14 million, right in line with other places across the country. Bit of a narrower range there, but in general, I think that these are yes, quote unquote, decent deals for investors, reasonable valuations, but also you're not being wildly undervalued if you're a founder here either, for sure. The same is true if you're raising money. You know, that's how much capital is raised sorry, this is Series A, I should say Series A round there. 10 million bucks, that is a very healthy Series A round. You can do a lot of things with $10 million. Some of those outperformers, by the way, on the top, we didn't really touch on this as much, but it is starting to become clear that the hype around AI as a topic that is loved by investors, is it a bubble? Yes. Does that mean that there will be no money made from it? No. So if you put AI in your deck, do you get more money and higher valuation? In 2023, the answer was kind of yes, unfortunately. I think now investors are a lot more discerning about what they consider AI, but this is true basically in every market, where the orange line is AI and the black line is everybody else. AI companies are raising more money at higher valuations at faster paces than non-AI companies. And I can see it in your faces. You want me to define what an AI company is. And I won't do it. Okay, so you might ask, okay, how did you build this chart, Peter? How did you distinguish between these kinds of companies? I did the easiest and most lazy thing I could do, which is I asked founders, are you an AI company? Is that a good definition? No, clearly not. Is it a definition that investors seem to agree with? Yeah. Yes, oddly. The point here is there are a ton of different kinds of AI companies. Every individual investor that you talk to will have a different idea of what is defensible AI. Do you have to build your own model? Is it okay to fine-tune another model? Is it okay to just have some proprietary data? Is it all right to just do ChatGPT calls through the API? Every investor that I talk to has a different opinion about what is going to be actually defensible as a business. So unfortunately, there's no consensus yet about what actually constitutes an AI company.
You see in the future this will actually, stratify a bit. There'll be tech-enabled AI companies versus AI and tools companies versus.
I'm honestly expecting to not even need to show this slide in a year or two, and it's just going to be like, did you use the latest tech? We don't talk about React companies or JavaScript companies. Right. We assume that you're using the latest technology in your tech stack. That is where a lot of this is going with AI for sure.
100%. So I think yesterday or the day before I was reading that Stripe, $1 billion in cash, the notion of going public is so far from the Collison brothers' minds, it seems like. And, that's not good for investors generally. You would say on the surface, that's not good for investors and not good for employees. However, they've done some things to try to ameliorate that concern. What's your general thought there? And then I'm going to ask some really targeted questions on that issue.
Look, the IPO question. It's the biggest question in tech these days. It's no matter how many acquisitions you have or secondary tender offers, you cannot get the level of liquidity that is needed for private startups to keep working without a bunch of IPOs. So that's base layer. We need IPOs back. I think the Stripe article and many other discussions about it suggest that if you are looking for IPOs, you would naturally look to the biggest private companies and say those would be the leaders.
Right.
They will not be. Stripe, SpaceX, Databricks, big private companies have two things that they are going for them that require them to never potentially IPO. One, they have a strong demand for their shares such that they can run employee tender offers on a secondary market whenever they want to. So the pressure from employees, which was a big reason why companies went public in the past, doesn't really exist for them. Two, they have unlimited amounts of capital available to them in the private markets. When you have sovereign wealth funds doing $6 billion rounds for XAI, what is the point of going public? So I can be regulated by the SEC and do a quarterly review?
Yippee.
Sounds exciting. There's not a strong case. Now, that is the most first world problems, right? That is like 5 to 6 companies that fit that class of company. But those companies are the ones that we want in the public markets the most. And I don't think they're going public in 25. I don't think they're going public in 26. I don't know when they're going public. I don't know why they would. So we will see more IPOs this year, but the biggest names, I think, are going to stay private.
So then, bringing it down a layer, how does that, and maybe before, how's that, impact venture funds? Because we're not seeing distributed cash anymore. We're seeing distributions come down, and I think you've got some, and you may want to also define things like DPI and so forth.
Absolutely. So this is data as of 2 days ago when we released this report. DPI means distributions to paid-in capital. How much money did you give back to your LPs? The real dollars, right? What we're all in this business to do, or what LPs are investing into venture funds to do. Now, as you can see, the vintages in recent years have almost no DPI. That is not unexpected. That is good, right? If you're a venture fund and you're giving money back to investors after a year, something either went unbelievably right or probably wrong. Venture is a long-term game. But even at the 2017 level, which was 7 years ago, the median venture fund has returned 0.25 its initial capital. So those investors are underwater at 7 years. They're probably underwater at 10 years. And then you start making money back. And this, again, venture has undergone a gigantic transformation in just how long these companies are staying private. If it used to be 10 years as a fund life cycle, it now needs to be, the expectation should be 13, 14, 15 years. 15 years to get money back? That money needs to be much higher in order to justify that illiquidity. So venture is faced with this problem of not a lot of recycled capital, and funds or private startups staying private a lot longer means the fund life cycle has extended. And that changes all these kind of metrics. But we can dig a lot more into how funds are doing. The reports on Carta, carta.com/data, if you want to read it for yourself.
So how should entrepreneurs then look at this when assessing potential investors?
Yeah.
Yeah.
Look, Josh Wolf at Lux Capital said, I think pretty recently, that 30 to 40% of VC funds will not be VC funds in the next 3 years. There will be that much decline in venture funding. Venture capital firms. I think that's a little pessimistic, but I don't think he's far off. And so what does that mean as an entrepreneur? This is a tough question when you walk into a venture capital meeting and you're trying to get money, but you need to ask some hard questions. Are you investing out of this fund? How much of this fund do you have left to invest? Are you raising another fund? It's tough, but you really don't want to be the last investment this venture capitalist ever makes. Are they going to continue to be VCs, not only because you want their support, but also because you would love them to participate in the next round too, most likely.
Right.
And those are tough questions. So I know sometimes founders, it can feel difficult to have empathy for your investors, but you should. They're struggling to fundraise just as many of you are.
That's amazing. As an active angel investor on my side, even, I so rarely get those questions.
Yeah, right.
So rarely. So I'd love for you to repeat those one more time because I think it's important for the founders in the audience to write those down, record them, whatever you do. But if you would, regurgitate that one more time for us.
Definitely. I've got so many good, while you're interviewing people, questions. Okay, so you need to ask the venture capitalist, how much of your fund do you have left to invest in this fund? Are you raising another fund? And what is your timeline, what is your reserve strategy? Are you expecting to do follow-on rounds in companies like mine?
Beautiful.
By the way, for the employees in the audience, I have one question that you should ask potential employers when you're joining a startup. Speaking of interview questions, which is, what price does my stock options need to achieve? At what price does the common stock make a profit in this company? So that does two things. One, it gives you a sense of whether or not the HR person that you're talking to knows their stuff.
Got it.
And they probably won't. It's rare that a recruiter can give you an answer to that question. But then you go up the chain. The second is the option price that you're given can look very fancy and say, oh, look, your stock will be worth so much money if we achieve this outcome. But it doesn't take into account the preference for investor stock. You get common stock, they get preferred. So a $100 million exit might feel good, but if 80 million of that is going back to investors first, then only 20 million goes to the employees and the founders. So you need to ask at what price common stock makes a profit.
Love it. Love it. My last question on the fund side, are you seeing within the data where more funds are pivoting? Again, you brought up the AI investing, and we obviously see tons more money flowing into AI. Generally speaking, across the landscape, do we see where more and more funds are moving in that direction to the detriment maybe of the enterprise software universe, B2B?
Yes, it was the best of times, it was the worst of times in enterprise software. Look, yeah, I think sometimes VCs get pilloried for this, but it is kind of true that, if you had looked in 2020, this fund was a crypto fund, and then they were an enterprise SaaS fund, and now they're an AI fund. That does happen. I'm not even sure that that's bad in some ways. You know, if they're a generalist fund, they're investing in whatever founders they think are going to make them the most profit. So I think it's sometimes good. We see two things happening. One, AI. Everyone is AI crazy. But two, there are a lot more funds who are open to investing into companies that are building things in the real world. Open in a way that I think they haven't been in many years. So as interest rates rose, as it got more expensive to build software companies, et cetera, I think the relative difference between building a software company and building a hard tech company has declined a little bit in many investors' heads. And they say, well, I'm already taking risky bets. Maybe we should build something in the real world. So I think that's great. I think it's really cool to see venture put its hard hat back on.
Beautiful. I'm getting ready to open it up for questions. So I know the crews are going to be running around with mics. And in fact, it looks like we can go ahead and do that. Kel?
Yep. If you guys have questions, just raise your hands and I'll run a mic to you. You got one coming in the back here. We'll get started.
And definitely ask your questions. I have to take him for dinner in San Francisco soon, and I'm gonna, you know, if I got to pay for that dinner, I'm gonna ask all my questions there.
Are you
guys.
paying for dinner? That sounds great. I love
It's
it.
great to see you guys. Transplant from San Francisco and lived in Sydney for a bunch of years, so go both places. I hate to be the one to ask this question because I'm kind of reasonably well known as the blockchain is a big lie and crypto is terrible guy, but
Reasonably well known.
I built the biggest blockchain and now I'm in App Estate. But it has to be asked. In the current regulatory environment with regulatory capture in full bloom and the president minting meme coins and SEC actions gone, why wouldn't, and A16Z and Mark and Chris advocating tokens for obvious reasons, they can get out faster.
Sure.
Why not mint a stupid token and do it that way? Is SEC going to come after you? Why are we talking about stock at all anymore? And again, don't do that, kids. Don't do crypto.
Look, I can't sit here and tell you that your meme coin isn't going to be valuable to you or be shut down by the feds. I don't think it will be. You're playing a very risky game if you do that. Look, we saw a lot of the combination of both of these in 2021, where companies, crypto and financial companies, would have their traditional cap table, and then they would have a token cap table where the ownership of that value is in tokens, and they would do both. And it actually, if you're a VC, it allows you to double dip on both sides, which is kind of nice. That went away almost completely, and now it's coming back a little bit, but it's not like your everyday enterprise SaaS startup is suddenly minting coins and having a financial crypto business as well. Apart from the fact that you shouldn't do it, maybe, it's also like a huge headache that you got to run. So if you want to fundraise that way, more power to you, wouldn't be my first choice.
A sort of a MicroStrategy pivot.
Correct. Yes. Yes. I remember in 2021, there was a company on Carta, I believe, that was like manufacturing something for sailboats that then issued coins, tokens for sailing. And I don't think that went well.
Yeah.
Yeah. Underwater.
Underwater.
Is the word I was looking for. Yeah.
There we are. There we are. All right, we got a number of questions out here. And where is the mic?
Hi there.
Hi.
I'm Jacqueline Olich. I'm a big admirer of both of you. My question for you, Peter, is what insights can you share about the disparities in funding raised by female CEOs compared to male CEOs across different venture stages? And how do these trends correlate with the percentage of startups led by women?
These are great questions. So we put out a study every year called the Annual Equity Report at Carta, where we dig into funding by demographic categories, race and ethnicity, as well as gender. The story, or the typical stat that you hear is that women founders raise 2% of venture capital. That is as a headline number, I think it's not wrong, but it is slightly incomplete for a couple of reasons. One, that is talking about any women in all women founding teams. So if it's a mixed gender team, if there's a man and a woman, both founders, that isn't counted.
Got it.
So what we did was we went back and we said, who is the CEO? We're only going to take account the gender of the CEO, and we're going to make that the stat. And when you do that, women funding jumps all the way to 6%. Not great. Slightly better, but not good. The other thing to note there is if you look at venture capital, obviously, when you read about a round in TechCrunch, you're probably reading about this gigantic round raised by a super late stage company, and so much of capital is raised in that later stage. And those CEOs tend to be white males because 10 years ago when those companies were founded, most founders were white males. So it takes time, right? And if you look at the earliest stages, pre-seed and seed, again, the share going to women CEOs is actually higher.
Got it.
Which is good. I'm not saying that this isn't something to be watched or it's not a problem, but to talk about it holistically ignores the fact that if you're looking for change, you got to look at the earliest stages first. And so we are making some progress there. Now for the downer, we lost some ground in 23 and a little bit more in 24. And what we think is happening there, and I don't want to get into whether or not VCs are biased or anything like that, I think one of the main heuristics is that in a riskier environment, VCs are putting more emphasis on being a repeat founder.
Yes.
Who are repeat founders most likely to be? White men, because those were the founders 6 years ago, 8 years ago when they were founding their first companies. So a preference for repeat founders is in some ways by definition a preference for less diverse founders. And that's a challenge.
Right.
That's a good question. I want to call on you, but I don't have a mic, so.
Thank you guys for being here. I heard a Silicon Valley reference, so I have a question around it. I remember there's the part where he's like, don't get revenue. Like that means that they'll look at your revenue as a multiple and you should just go users.
Yep.
What are you worth if you just have users? But obviously in the landscape, we want people to, maybe get to cash positive, and, I'm hearing that from investors. So what are you seeing in the combination of like intangibles? A company has revenue, maybe it's not a ton of revenue, or maybe it is a ton of revenue, but then how are VCs thinking about a multiple, whether that's like, I guess, the moat or, whatever. How are you maybe seeing that in the data right now?
Let me jump on this for
Please.
1 second, then I'll allow the data guy go in here. But first of all, if you're building a business, you should have revenue. You should never shy away from revenue. I don't know why anybody would, why you would believe the notion of revenue is a bad thing is ridiculous, because if you want to survive when that investor class may not be willing to invest in you, revenue is going to be the way you survive. So let's just debunk this myth of no revenue is a good thing. Revenue is absolutely crucial. It's what makes a business a business. If you don't have revenue, I would call you almost a nonprofit, but even nonprofits have revenue. They have donors. So please, revenue is important. Every business should have revenue. If you're building something that doesn't generate revenue, you're not actually building a business. You're building some scaffolding that's going to collapse in on itself. Rant done. Peter, please, data.
I'm glad you referenced that august documentary, Silicon Valley on HBO. Look, when you talk about multiples, we can have a long conversation as to whether multiples at, say, pre-seed, seed, and Series A even make sense as a financial mechanism. Our data suggests sometimes not. But the amount of revenue, which one, yes, you should have revenue. If you are building something that is not SaaS, it's not software, it's a different kind of business model, sure, you can put things off for a while, you can talk to investors about that. But if you're building an enterprise SaaS app, you need revenue, one. Two, the amount of revenue that you need has gotten higher.
Correct.
Sometimes much higher. In 2020, 2021, what we were seeing around the valley was that if you had $1 million in ARR, it's time to start talking about your Series A. I would say that's 2.5 or 3 million these days in the Valley. But that number is in constant conversation with your growth rate. So if you have much less than that, but it's growing incredibly quickly, you can still talk to investors. So it's not as though someone can give you a stamp and say, you passed an ARR milestone, congratulations, here's your funding. It doesn't work like that. But I will say for many entrepreneurs, and this is the difficulty for those that started their companies in, say, 20 and 21 in the old world, and now they're dealing with new world expectations, the underlying shift in those metrics has been swift and difficult.
Yes.
Which accounts for some of this, right? If you have to keep your business alive for a lot longer and figure out what to do with revenue, that black line is new hires, not hiring very much. Thank you for the lead-in question.
Thanks, y'all. Harrison Satcher, appreciate you both being here. I think a lot of us in this room are very focused on ecosystem building in this area. And so a question for each of you. Peter, have you done any analyses on the geography of, let's say, insularity of ecosystems? Do we see cross-pollination of investors in SF and New York funding, let's say, startups here in the Triangle? And Bill, what role do you see in ecosystem building for bringing in outside capital versus, just we can do it all here, and we should be focusing on kind of building it up here?
Got it.
Thank you.
That is a fantastic question. I would say that typically we think of ecosystems in the United States in basically 3 tiers. One is hyper-mature ecosystems. There are only 2, New York and the Bay, where it's effectively self-sustaining. The second category is diverse up-and-comers, and the third category is we call them challenger ecosystems. Diverse up-and-comers are places like LA, Boston, Austin, a couple others, where you probably started, Boston is the perfect example of this, where you started with a single industry, biotech in Boston's case, and then sort of the flywheel has taken root such that Boston is now a great place to build health tech and SaaS and other industries. Over the last 10 years, it's kind of broadened out.
Yes.
And I think that's actually a model that many other places can copy. Now, your question is about where does the money come from, right? A lot of the times, it will start with local capital. There is no way to jumpstart an ecosystem without a good dependence on local capital, right? There's not a lot of Silicon Valley investors who are going to be spending a ton of time in Raleigh. And that's okay. They don't need to. You have a wonderful ecosystem of early stage VCs. What we do see is that there's a lot of places around the US where pre-seed, seed, actually, funnily enough, it usually starts with seed as the place where the capital grows, and then it goes back into pre-seed and up into Series A. And the reason for that is angel groups are a little bit less established in these areas, and funds want to start with a check that is meaningful, so they usually start with seed. We see that in a lot of different places. When you're talking about Series B, Series C, Series D, really late stage rounds, outside of biotech here, it's probably going to come from sources that are more coastal. So insularity is a wonderful word. I might steal it. I'll credit you in the next LinkedIn post. But it's a great way to measure an ecosystem. I don't think that having, for instance, a high degree of outside capital at later stages is an indication that your ecosystem is failing. It's actually mostly the way of the world.
As it relates to ecosystems, thank you for that. For me, I go back to this wealth creation discussion, and the best way to generate that insular local capital is to have more founders and teams exit and recycle that money, begin to recycle money into the community. Some of those founders will become angel investors, and I say founders, some of those exited individuals become angel investors, some will become LPs in other funds, some will do nothing but go and enjoy at the beach. But the idea is you have to start that flywheel. And one area I think we've lacked in the Triangle, just in harsh reality, is seeing more of our community reinvest. We haven't generated enough active activity such that there's enough reinvestment that happens here. And so just like we've got the bandwidth mafia out there, we've got the GDC mafia floating around out there, we need to create more mafias, we need to create more opportunities for these people to come together and become those future angel and then pre-seed LPs, such that then it's easier to then attract external capital. But I think it starts with us creating a bigger base layer here of activity. And yeah, that's what I'm bound and determined to do.
What do wealthy people do with their money? In Dallas, they might invest in real estate. In San Francisco, they're giving that money to young entrepreneurs. Sometimes because they want to, sometimes because they want to talk about something interesting at the dinner party, right? But angel community is a big one. Yeah, we need more organized crime families. Yeah. Couldn't agree more. Couldn't agree more.
I like that.
That's it, guys. We're all set.
All right.
All right.
Thanks so much for your time.
I don't think I could stand another hour of slides, but those were great. Thank you very much.
I'll try to do
Appreciate
less
it.
next time.
No, it was great. Thank you. If you don't follow Peter, you're not learning about how equity gets distributed inside companies. He publishes a Carta Data Minute. I think I get one a week. Follow him on LinkedIn. He makes these slides available to everybody. It's a great resource to see where you are and benchmark your company. So that's the end of opening session for day 2, but there's more to come. AI machine learning pitches are going to be on this stage. Preclinical biotech is going to be on Fletcher. Let's give Bill and Peter one more round of applause. The app is open. The meeting rooms are open. Make some connections. Let's have a great day, folks.